Welcome to the Deep Dive, where we cut through the noise to bring you the insights you need to be truly well-informed. Today, we're diving into a question that puzzles, well, probably most investors at some point. How do you really know what a share in a company like Amazon or AT&T or even ExxonMobil is truly worth?
Yeah, it's a big question. And it's more than just idle curiosity, right? Because unlike, say, a piece of art where value can be totally subjective,
Right.
a stock's underlying worth, well, it should be grounded in something tangible, something real. And if you've ever caught yourself thinking, the price doesn't really matter as long as someone else pays more later.
Uh-huh. The greater fool.
Exactly, you've hit on the greater fool theory.
And as the investing world found out the hard way during the dot-com bubble, that specific game, it can get incredibly expensive very fast. But here's what's kind of surprising. At its heart, figuring out a company's value is, well, maybe more straightforward than you'd think. And this deep dive is really designed to give you that clarity.
That's our mission today. We want to pull out the top 5 sort of foundational ideas from Aswath Damodaran's excellent book, The Little Book of Valuation. Think of this as your shortcut, really, to understanding how the pros actually figure out what a company's worth.
Absolutely. And by the end of our chat today, you'll have, hopefully, a much more robust toolkit. You'll be able to navigate the stock market with, greater confidence and make decisions that feel more grounded. So let's get into it.
Okay, so to kick things off, the most fundamental thing, maybe, about valuing a stock is that it really boils down to just 2 main approaches. Think of them like 2 different lenses, right? Each giving you a unique view. There's the relative approach, and then there's the intrinsic value approach. Now, the relative approach, it works on a single, pretty intuitive idea. Everyone wants to pay as little as possible for basically identical things. It's kind of like, imagine you're standing in front of 2 houses, exact copies right next door, but one's listed at $200,000, the other's $300,000.
Yeah.
I mean, which one are you going to choose? It's obvious, right? And what's interesting is how the intrinsic approach builds on slightly different, but I think equally powerful human tendencies. First, there's that undeniable fact.
Yeah.
Everyone prefers money today over money tomorrow. We just do.
Yeah. Instant gratification, inflation, all that.
Exactly. And second, that everyone prefers a sure bet over a risky one. Certainty feels better. Now, while some investors might, really favor one method, the really savvy ones know that you kind of need both. They aren't just about spitting out a number, they give you a solid framework. My own approach, I often use relative valuation first, just to screen for companies that look maybe interesting, potentially cheap compared to peers.
Right, like a first pass.
Yeah, exactly. And then I switch to intrinsic valuation to really dig in and decide if that specific company is actually worth putting money into.
That makes a lot of sense, using them together like that.
Yeah.
Okay, so let's zoom in on that first lens then, a quick guide to relative valuation. Like you said, it's all about comparing something to similar things and picking the cheaper one, essentially. Now, in the stock market, it's rarely as neat as those identical houses.
No, definitely not.
But the basic idea holds. So step 1 is critical. Finding truly comparable assets, that whole apples to apples, oranges to oranges thing. For established companies, maybe like AT&T or ExxonMobil, finding direct comparisons is usually, well, easier. There are other telecoms, other big oil companies. But for a giant like Amazon, that's way trickier. I mean, Walmart comes to mind.
Yeah, but
they're mostly physical stores, right? And Amazon's grip on U.S. online retail is just huge, like 50% of the market. It's hard to find a true peer.
right. Once you have identified some potential comparables, though, the second step is using a standardized variable. You can't just compare stock prices directly.
No, that tells you almost nothing.
Exactly. You need to scale the price against something meaningful. And the price-to-earnings ratio, the PE multiple, that's a really common and usually a good place to start. It basically tells you how much the market is willing to pay for every dollar that company earns.
Okay, and then step 3. Adjusting for the differences. Because, like we said, it's never a perfect comparison. This is where the art comes in, I guess. You can't just pick Walmart over Amazon because its PE is lower. That doesn't make sense by itself.
Right.
Typically, a company trades at a lower multiple because investors expect its future earnings growth to be slower. Now, looking at past growth isn't a perfect predictor, obviously.
Of course not.
But it can be a decent first check for finding maybe interesting situations. Sometimes you do find cases, like maybe Verizon or Royal Dutch Shell sometimes, where they seem to have stronger growth than their peers but still trade at a relatively cheaper multiple. Those can be worth a look.
And this really gets at a core assumption behind relative valuation, the idea that the market is, let's say, correct on average, but maybe wrong on an individual company level.
Okay.
It assumes that, yeah, the market prices things mostly right, but it might mess up on one specific company, and that's your opportunity. But, and this is crucial, that assumption has a big flaw. Think back to the dot-com bubble, like 1999.
Oh, yeah.
If you picked a company with a PE of 100 just because its competitors were trading at PEs of 200, well, you were still buying a wildly overvalued stock.
We weren't buying cheap, just less expensive.
Precisely.
Yeah.
In a market that was just fundamentally overpriced.
Mm.
And that's why you always need to cross-check relative valuation with an intrinsic view. They really have to work together.
That's a really important warning. Okay, so if relative valuation alone can lead you astray, especially in bubbles, then that intrinsic approach sounds absolutely vital. Let's shift gears then. How does that work? Let's circle back to those two core ideas you mentioned.
Right, the time value of money and risk aversion.
Exactly. To really get this, let's make them concrete. Okay, listener, what would you prefer? $10,000 in your hand right now, today, or $1,000 a year for the next 10 years? Almost everyone takes the $10,000 today, right? That nails the first principle. We prefer money now over money later. And it's not just impatience. There's inflation eating away at future money's value, too.
Absolutely. And for the second principle, think about this. I offer you a guaranteed $1,000, no strings attached. Or you can flip a coin. Heads, you get $2,000. Tails, you get $0.
Ooh, the gamble.
What do? Most people take the guaranteed $1,000. That shows the second principle. We generally prefer a sure thing over a risky bet, even if the risky bet has the same or even slightly higher expected payout on average.
Okay, got it. So with those two ideas firmly in mind, money now is better than money later, and certainty is better than risk, we can finally talk about the single most important variable in intrinsic valuation, which is also called discounted cash flow analysis, right?
That's right, DCF analysis.
And that key variable is the discount rate. Can you unpack that?
Sure. The discount rate is basically the rate you use to figure out how much less future money is worth to you today. And it captures both things we just talked about. It accounts for the time value of money, inflation, opportunity cost, and accounts for risk.
Ah, okay. So the riskier the future income seems.
The higher your discount rate should be. You demand a bigger discount, a lower present value, to compensate for that uncertainty. To put numbers on it, say you use a 15% discount rate. That's like saying $1,000 you expect to get next year is only worth about $870 to you today.
Wow, quite a drop already.
Yeah, and that same $1,000 expected 10 years from now, using that same 15% rate, it's only worth about $247 today.
Only $247. That really shows how much future money gets discounted, especially further out. That discount rate is clearly powerful. It's huge. So how do we apply this to stocks? Well, you have to remember what a share of stock fundamentally represents. It's a claim. It's your claim on a tiny fraction of all the future earnings that company will ever generate. So 1 share of Amazon, that gives you a claim on what? 1 divided by roughly 504 million of Amazon's total future earnings forever.
Okay, that makes sense.
Yeah.
But it's important to clarify, when we talk about earnings here, we don't just mean the accounting net income number, right?
No, not exactly. We're really aiming for something closer to what Warren Buffett called owner's earnings.
Owner's earnings, okay.
Think of it as the actual cash profit that's left over after the company has reinvested everything it needs to maintain its competitive position and, fund its growth. It's the cash that could theoretically be handed back to the owners. So, if you could somehow know with perfect certainty what those owners' earnings would be from today until the end of time.
Which we can't, obviously. Right.
Okay.
Which we can't. But if you could, and then you used your chosen discount rate to bring all those future earnings back to today's value, that total would be the intrinsic value of the entire company's equity. Then you just divide that total value by the number of shares outstanding.
And boom, that's your intrinsic value per share.
Exactly. And if that number is higher than the current market price, well, that might be a signal to buy.
Okay, but forecasting owners' earnings from now until infinity sounds impossible.
It pretty much is. So in practice, what analysts do is estimate those owners' earnings for a more manageable forecast period, maybe, say, the next 10 years.
Okay, 10 years. That's more doable.
Yeah. And then, for all the earnings beyond that 10-year window, you estimate what's called a terminal value or going concern value. This basically represents the value of the company, assuming it keeps operating indefinitely, but at a more stable, mature, maybe slower growth rate forever after year 10. because you can't forecast details forever.
Right, it becomes more like an annuity or something.
Sort of, yeah. So you add up the discounted value of the earnings from years 1 through 10, and you add the discounted value of that terminal value. That sum gives you the total estimated intrinsic value of the company.
Okay. And here's another key idea, right, from Benjamin Graham, the margin of safety.
Absolutely critical.
Wow.
Graham taught Buffett this. You're not just looking for a stock where your calculation says it's worth maybe 10% more than the market price. That's too thin.
Not enough buffer for error.
Exactly. You want a substantial buffer.
Yeah.
If you, for example, require a 15% annual return on your investments, you might insist that your intrinsic value calculation shows the stock is, say, at least 40% undervalued compared to its current price. You need that margin of safety because your estimates will be imperfect.
Right. So calculating intrinsic value sounds simple. Conceptually discount future cash flows, but it's obviously not easy in practice.
Definitely not easy. Estimating 10 years of owners' earnings, that involves making so many assumptions. How fast will revenues really grow? What profit margins can they sustain? How much capital will they need to spend just to stay competitive, let alone grow? And your final valuation number, it's going to be no better, really, than the quality of those assumptions you plugged in.
Which perfectly leads us into our next big insight. Some, let's call them fundamental truths about valuation itself. Because even using both relative and intrinsic methods, there are still quirks, potential traps. But if you're aware of these realities, you can seriously improve your odds.
Yeah, knowing the limitations is key. And the first truth, maybe the most humbling one, is that all valuations are biased. Period.
Biased? How so?
Well, think about that Amazon forecast again. Why did you assume 20% revenue growth per year for 10 years instead of 10%? Or 5%.
That choice makes a huge difference in the final number.
A massive difference. And you need to be really honest with yourself about why you chose that number. Chances are there's some subconscious bias creeping in. Maybe you just, really admire Jeff Bezos. Or maybe you already own the stock and you want it to be worth more.
Where your buddy keeps telling you how great it is. Confirmation bias.
Exactly. Recognizing your own potential biases is almost more important than nailing the math perfectly. You have to actively question your key assumptions, especially the optimistic ones. Ask yourself, why do I believe this? Could I be wrong?
That's great advice. Okay, so truth one, valuations are biased. What's the second truth?
The second one is also a bit tough, but it's reality. Most valuations are ultimately wrong.
Wrong. So why bother then?
Well, because even if they're not perfectly precise, relative and intrinsic valuation are still the two best tools we have. Everyone is working with the same cloudy crystal ball. And here's the interesting part. Sometimes your valuation doesn't need to be perfectly accurate.
What do you mean?
Well, if a stock is just screamingly cheap based on your analysis, even if your intrinsic value estimate is off by, say, 30%, it might still be a fantastic buy. Benjamin Graham had a great quote about this. He said something like, "It is quite possible to decide by inspection that a woman is old enough to vote without knowing her age."
Or that a man is heavier than he should be without knowing his exact weight. I love that.
Right. Sometimes the signal's so clear, you don't need the exact number. Being approximately right is often better than being precisely wrong. Sometimes less precision is actually more useful if the overall picture is clear.
Okay, less is sometimes more. That ties into the next point, doesn't it? About focusing on key variables.
Exactly. Take that revenue growth estimate again. You could try to model dozens and dozens of tiny factors that might influence it.
Yeah.
But if you do that, you risk getting lost in the details, missing the big picture, missing the forest for the trees.
Right. Analysis paralysis.
Totally. Instead, it's often much better to focus intensely on just a few really important drivers. What truly matters. Maybe it's the competitive landscape, the quality of the management team, and the realistic potential size of the total market they're operating in. Get those roughly right, and you're probably on a better track than trying to model every tiny variable.
That makes a lot of sense. Keep it focused on what really moves the needle. So just being aware of these truths, that valuations are biased, often wrong, but that precision isn't always needed, and focusing on key drivers is crucial. That awareness itself helps you, the listener, make better, more grounded decisions. It's not about finding the perfect number. It's about understanding the range, the risks, and your own biases.
Well said.
Okay, our fifth and final major takeaway really ties all this together. And it is, context matters, hugely. You absolutely cannot use a one-size-fits-all approach. You have to adjust your analysis, both relative and intrinsic, based on the type of company you're looking at. Valuing Amazon, a high-growth company, is fundamentally different from valuing AT&T, which is arguably in decline, or ExxonMobil, a super cyclical commodity business.
Exactly. Let's take them one by one. Growth companies, like Amazon. When you're valuing them, the absolute key is figuring out how scalable that revenue growth really is.
Right. Can they keep it up?
Yeah. And like we touched on, that means digging into the competition, assessing management's execution, and estimating the total addressable market. How big can this realistically get? Future profit margins are another huge question mark for growth companies. Often they start with low or even negative margins.
To fuel growth, yeah.
Right. So a common approach is to model margins gradually increasing over your forecast period, maybe scaling up towards the industry average as the company matures. That seems reasonable. But you also need to decide when to shift them into that stable growth phase for the terminal value calculation. You probably shouldn't wait too long. Eventually, even the best growth companies slow down due to sheer size or competition catching up.
Okay, that makes sense for growth. Now, what about companies in decline, like potentially AT&T? What's different there?
Well, first, you have to be really skeptical about large capital expenditures. Is the company just throwing good money after bad?
Like Buffett's quote about leaky boats.
Exactly. Buffett said, "Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks." You need to ask if they're just trying to patch leaks instead of finding a new boat. Another huge factor for declining companies is the increased risk of bankruptcy. That becomes a much more real possibility.
So how do you factor that into evaluation?
You often need to build, essentially, two different scenarios. Scenario A, the company survives, maybe turns things around or just manages a slow decline. Scenario B, the company defaults, goes bankrupt, assets get sold off. You estimate the value in each scenario, and then, this is key, you assign probabilities to each outcome. Maybe you think there's a 70% chance they survive and a 30% chance they default. You weight the outcomes by those probabilities to get a more realistic expected value.
Wow. Okay, so probability comes into play much more.
Definitely. And it also means the company's balance sheet, its assets and liabilities, becomes much more important to analyze for a declining company than it might be for a high-flying growth stock. You need to know what's actually there if things go bad.
Got it. Okay, finally, what about those cyclical commodity companies like ExxonMobil?
The cyclicals. Their results swing wildly depending on where we are in the business cycle or where commodity prices are.
Yeah, oil prices go up and down.
Exactly. And one of the most counterintuitive things about them is they often look the cheapest, like the lowest PE ratios, right at the top of the cycle when profits are booming.
Things seem great.
Right. And they often look the most expensive, highest PEs at the bottom of the cycle when profits are terrible or even negative. But often, the reality is the complete opposite.
Yeah.
It might actually be most undervalued at the bottom and most overvalued at the top.
That's tricky. So how do you deal with that in valuation?
The key is to normalize their earnings.
Yeah.
You can't just use the latest year's earnings because that could be an app peak or a trough. You need to figure out what their earnings power would look like over a full business cycle, smoothing out those highs and lows.
How do you do that?
Well, for a commodity company like Exxon, you might look at the average oil price over the last 10 years, say, and estimate what their earnings would be at that average price. For an industrial cyclical, maybe you'd look at their average profit margins across an entire economic cycle. You're trying to find a mid-cycle or normal level of profitability for fair comparisons and for your intrinsic valuation inputs.
That's incredibly helpful. Understanding these different contexts, growth, decline, cyclical, is clearly essential. It directly impacts how reliable your valuation is going to be. Like you said, a one-size-fits-all approach just doesn't work here.
Not at all. You have to know which lens to use and how to adjust the focus based on what you're looking at.
Right. Okay, so as we wrap up this deep dive, let's recap the core idea. Valuing a company, it doesn't have to be this completely opaque, intimidating thing. These two main approaches we discussed, relative valuation and intrinsic valuation, they really do give you a powerful toolkit to get a much better handle on what you're actually buying.
Absolutely. Hopefully this conversation has given you a solid foundation in what can seem like complex principles, but hopefully also a clearer path towards making more informed, more confident investment decisions yourself.
And as you continue your own journey exploring financial knowledge, here's maybe a final thought to chew on, building on those truths about valuation. Given that we've accepted that most valuations are inherently wrong to some degree, what does that really mean for your personal quest for financial understanding? And how might embracing that imperfection, that uncertainty, actually be your greatest strength on the path to financial freedom?
Something to think about. We definitely encourage you to continue your own deep dive. There's always more to learn.